So people in the class, let me now introduce to you in total all the yields that you should know in this chapter of fixed income security for CA final AFM and CMA final SFM. The YTM and the most basic that we have already learnt, which all of us would almost know it, right? That if you buy a bond today and if you hold the bond till maturity, based on the price that you pay today and based on the cash flows that you will be able to receive in future till maturity, how much return, how much IRR would you be able to make on this bond is the YTM, correct? And that is how the formulas of YTM look like. An easy thing, right? Simply the IRR of the cash flows, the price you pay and the cash flows you receive, outflow and inflow when compared to calculate IRR is YTM, the actual return you will make in future. But do you people agree that we may not be able to hold the bond till maturity? First possibility. Or even if you hold the bond till maturity, let me tell you, YTM has a catch, details of which I don't want to cover in this lecture because we want to keep it limited. But let me try to give you a practical illustration about how much would my actual return be if I hold the bond till maturity. People in the class trying to explain to you the concept of realized yield. All right, let us be very quick to understand it. For example, let us imagine that the bond has 3 years of time to maturity left now, right? Today the bond is issued in the market. So for example, let's imagine, let me create the situation. Sir, let's say the face value of the bond is 1000. All we are supposed to come to people in the class, page number 65 of the outnotes where we are writing this down. Face value 1000 rupee, right? Then coupon rate for example is 10%. Time to maturity for example is 3 years. So how much is the amount of coupon? 100, 100 and 100. And for example, which is why uh, the value of the bond, so let me say YTM today, right now in the market YTM is 12%, which means, do you people in the class agree to the fact that all these future cash flows, cash flow 1, cash flow 2, cash flow 3, all these future cash flows will be discounted at the rate of 12%. People, kindly give me the value of the bond based on this 12% discounting rate. Waiting for your responses. What should be the CMP of the bond in your opinion at which I buy it? What is the CMP of the bond at which I should be able to buy it? I need your response, please. So ignoring rounding off, can I say 1.1 to divide equal 0.711 something, so 2.40 into 100 m plus 1000 divided by 1.12, sorry, 951.96 is what I'm getting, ignoring rounding off, only on the calculator I'm saying, without considering 3 decimal points, everything, right? 951.96. Someone in the class please confirm. Right? So now let's imagine what happens. Right? Now let's imagine what happens. Do you agree this is the price you have paid to buy the bond? Which means, can I consider this to be your outflow actual amount paid? 952.2 on a rounded off basis. Sahil, all right. So let me update the price as per our standard rule, which ICI needs to round off all the present annuity factors or present value factor till 3 decimal points, which you are saying as 952.2. As per the standard rule, it is this. Fine. And these amounts, as we know, are going to be my inflows. Correct? But let us now understand what will practically happen, right? Suppose I want to make an investment for 3 years, 3 years, sorry, 3. 3 years is my holding period, correct? Today, this much of an amount has gone out of my pocket. At the end of first year, what I receive, sir, 100 rupee of cash flow. Do I need this cash flow in my hand today? No, I want it at the end of third year. At the end of second year, again you receive 100 rupee. Do you need some cash flow? No, I need it at the end of third year. Then what do you do? Sir, these cash flows, people in the class, please observe. 1 second. People in the class, please observe. These cash flows which you receive at the end of respective year, which you don't need actually. All right. So these cash flows which you receive at the end of every year, which you don't need, which you need only at the end of third year, what I will do? I will try to reinvest them, which means this 1,000 rupee, everyone in the class, let me bring it down. This 100 rupee of coupon. Similarly, this 100 rupee of coupon. Similarly, this 1100 rupee. 1 second. Will be reinvested for respective number of years. Meaning to say, suppose at the end of first year, as I've clearly spoken to you that YTM in the market, which is the interest rate, depends on the economy, country's economy, global economy, which means the YTM keeps on changing. Suppose what actually turns out to be the YTM in the market at the end of first year is 10%. Unfortunately, the interest rate in the market falls. So rather than 12%, which was the YTM on the day today, YTM on that day falls to 10%, which means on this day, when I make an amount of investment, right? On this day, when I make an amount of investment of this amount, how much this amount turns out to be? Similarly, if I make an amount of investment of second year's 100 rupee, this will get invested for 2 years at the rate of 10%. Sir, this will get invested again at the rate of, suppose, 10% only for 1 year. How much this amount on the day of maturity turns out to be? Let us calculate. People, please do it. So 100 into 1, so 1.1 multiplied by 100 equals to is 121. At the rate of 10%, when this 100 get invested, 1 second. It becomes 121 and this becomes 100, and the total amount I will receive at the end of third year will be how much? Sir, this 100, 1 second, this 100 has become 121, this I receive. This 100 become 110, wait, this 100 and become 110, this I receive. And the 100 and 1000, which is the amount from bond I'm receiving in the last year, that is not invested at all because that is received at the end of third year. So 1000 plus 100 plus 110 plus 121 is the total of people 1311 I receive. Would you allow me to make a change? Please, 1331 I receive. Will you allow me to make a change? Because otherwise, what will happen? You guys will get confused. Let me, because what happens is that my coupon is 10. If I keep the reinvestment rate also as 10, you will get confused. Rather, let me change the rate. So let me invest the amount randomly. So 100 plus 9%, plus 9% was 118.81, which is fine. 118.81. Similarly, this amount will be 111. And the total amount I will receive back is 1000 plus 100 plus 111 plus 118.81 is 1329.81. 1329.81 being my total inflow on that day, on the day of maturity. Now, if I ask you the simple question, that how much has gone out of your pocket at point zero, people? How much has gone out of your pocket at point zero? That is everyone in the class, simply the amount of 952. This much has gone out of your pocket at point zero. And against that outflow, how much inflow have you received? So you will say in total you have received an inflow of 1329.81 at the end of third year. All these inflows become irrelevant in that case, because these intermediate inflows, that I received in between the amount of coupon, were reinvested to get the final inflows on this date. So let me do one thing. Let me make these two amounts in red and show them as reinvested. These two coupon amounts again got reinvested. An ultimate amount of cash inflow I received on this day is everyone, or at the end of third year, is this one. So my question to you all now is that, sir, if 952 is the amount of outflow, right, and the amount of inflow is 9329.81, right, no other inflows outflows I have received actually in between. Can you find out the amount of return or the rate of return I have made on this investment? Do you realize now it becomes a simple case of investing an amount at 0 point and getting an amount at the end of third year, and I just need to find out that compounded rate of return. Everyone in the class, what are you giving me as an answer? 946.83. Sahil? So I don't know, we'll figure it out. But if I ask you the simple question that outflow at 0 point is 952 and inflow at the end of third year is 1329.81, can you give me that annualized compounded rate of return you have made over a period of 3 years? Yes, sir. Common sense. Let us simply feel it to be my present value. Let us simply feel it to my future value. Sir, using the two amounts, can we calculate an R, a rate of return, very easily? Using the two amounts, can we calculate a rate of return? Right? The rate of return I simply needs to calculate. Correct? So rate of return, everyone, will be 952.2, which is the, so let me say it this way. So can I say present value into 1 plus r to the power n is equals to future value? And if you realize, all the numbers you have with you except for this r marked in red. Except for this r, you have all the numbers available with you. So let me find out that compounded annual rate of return r, everyone, it is 952.2, that is multiplied by, it is similar to, do you remember in case of, I taught you to calculate the growth. I taught you in case of equity valuation, the number of growth in the dividends and earnings using historical data. That is exactly similar to this. I'll take you to that page. Hold on for a minute. 1 plus r to how many years? Sir, 1 compounding, 2 compounding, and 3 compounding. to the power 3 is equal to 1329.81, and in this calculation only r is missing, people. So you will over here learn one more thing, the concept of dirty power, everyone in the class. Yes. How to solve it? So obviously you must be realizing, sir, it is like 1329.81 divided by 952.2, right? To the power 1 by 3, right? So let me say 1 plus r is equals to. In the LHS, I'm keeping this 1 plus r, this 3, I've sent it here, so it becomes 1 by 3 over here, not 1 by 2. It becomes 1 by 3 over here, right? To the power 1 by 3. Sir, how to solve something for 1 by 3? Let me tell you. Please don't confuse two different things. I could have taken a period of 4 years. I could have taken a period of 4 years, and in which case if I put a 4 over here, the solution become easy for you. You have to just press the under root twice, which means the concept of realized yield is only this much. Now whatever you learn is the concept of dirty power, which I will teach. But having said that, let us find out the percentage of r, and then I will conclude for you what do I mean by the concept of realized yield. Let us find out r for now. R for now, sir, 1329.81 divided by 952.2, right? It is 1.3965 something something on my calculator I'm getting. How many of you remember that process of doing things 12 times? So how we used to do it? I will make you people write this down separately, but right now just try to solve it. So I have to press under root 12 times. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. On my calculator, I'm getting 1.0000081550 something. From this, you have to minus 1, because eliminate the effect of 1, I'm getting 0.00000815 something, to which you have to multiply your power. If the power is 1 by 3, multiply 1 by 3. If the power is 9 by 8, multiply by 9, divide by 8. So right now, I have to divide by 8, correct? Sorry, right now I have to divide by 3. Multiplying 1 by 3 is divided by 3. You have to add 1 to it, right? And after adding 1, it is 1.000 or 4 times 0, 2718 something. Now into equal to 12 time, into equal to 12 time, into equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1 plus r I'm getting as 1.11777 something, people. The number of r, if 1 plus r, let me write it down for you. One second, let me write down using blue pen. After solving this number, just let me confirm the answer. On my calculator it is 1.11777. I'm reconfirming it. Hold on for a second. 1329.81 divided by 952.2. All right. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Minus 1 divided by 3 plus 1. 1, 2, 3, 4, 5, 6, 8, 9, 10, 11, 12. 1.11777 something. Right? 1178. So R is equal to 11.78% per annum. Needless to mention, it is compounded annually, because the formula being used to calculate this R was an annually compounded formula, and hence this rate is also annually compounded, 11.78. People in the class, I will narrate to you again the process of calculating dirty power, but I want to, for now, get distracted from that and come to something else. How do you calculate 11.78 is a different concept I will teach you, but for now, can we please understand the realized yield is 11.78? Sir, my YTM was 12%. These investment were at the rate of 9 and 11%. What is this 11.78%? Let me tell you. Do you agree that at 0 point we thought that, please understand the most important thing, the conclusion. At 0 point we said YTM is 12. How did you explain the YTM to me? Sir, the rate of return we will get if we hold the bond till maturity. So see, if we are holding the bond till maturity, we should be earning 12%, right? Correct. But then why are you earning 11.78% is the catch. Listen to this. YTM, when I say that YTM means the return till maturity is 12%, I make an assumption that all these investments will be made at the original YTM of 12%. This is an underlying assumption of YTM. However, people in the class, let me clarify the things to you with the clarity which are not even being taught in general in the regular batches in the market. Sir, in reality, the YTM in the market will change that you've been taught, right? And with the change in YTM, my actual rate of reinvestment of the coupon will not be 12. The assumption will not be true. My actual amount of investment may be 9 or 11%. And when that happens, the amount I realize over here is different, is not at the rate of 12%, but is a different amount. And which is why the actual return I will be able to realize based on the actual reinvestment rates will not be 12%, it will be different. And when I calculate the amount of annualized compounded return based on the initial outflow and the ultimate inflow, it turns out to be 11.78%. People in the class, could I, everyone, convey to you the concept of realized yield? And let me tell you, in our class, we don't we don't mug up the terminologies, we follow the flow. Right? Realized yield means how much I could actually realize. Current yield means the yield which is based on my current income. Common sense, please. When you invest in a bond, as I said, you are able to earn the return in two ways. First, you return the first you receive the amount of coupon every year, and also you earn the amount of capital gain. Right? So capital gain is not your current income that you receive only at the end. How much is the amount of income which is current, which means which you receive every year annually, the amount of coupons, right? So in this case, the formula ignores the capital gain and considers only your current income, which is coupon amount, and formula simply becomes, in the denominator comes, what is the basic understanding of return we have created in the class. In the denominator comes the amount of investment, the CMP, and in the numerator comes the amount of coupon, only the coupon. So when you take annual coupon in the numerator, when you take in the denominator the CMP, right, automatically the yield which is calculated in percentage terms obviously is the current yield. Right? So current yield is clear, realized yield is clear, and the YTM is obviously clear. These are the three kinds of yields you must know for the entire chapter of fixed income securities. All right. People, please.